Hello there, YouTube, and thanks for joining me to another video where we break down different mortgage topics to the very basics. Before we get started, please subscribe to the channel if you're enjoying the content, share, like, and of course, comment on things you would like to add or topics you want me to break down. Now, as you can see in this video, we're going to talk about mortgage programs that are available when you're trying to refinance your mortgage. So what are the most commonly used ones? What options do they have to offer? And overall, what are the biggest differences between them? So the first two most common mortgage programs in this video we're going to review are going to be conventional and FHA. The third most common one that's out there is going to be a VA mortgage for veterans. Hi guys, so the first program we're going to review here is going to be a conventional mortgage. Now, the most important thing about a conventional mortgage is that it's conforming to Fannie Mae and Freddie Mac. What I mean by that is that if a client wants to purchase a home through a conventional program or refinance their mortgage through a conventional, that client needs to qualify based on the underwriting guidelines set by either Fannie Mae or Freddie Mac. So again, conventional needs to conform to those guidelines. Now, the other feature that is very common with conventionals are the fixed term that they have available, anywhere ranging between 10 to 30, and they do have a fixed rate or an adjustable interest rates available to them as well. And our second program here is FHA. So FHA is an abbreviation for Federal Housing Administration. FHA is also a government-backed mortgage program. What government-backed program means is in case of a client defaulting under a mortgage, that particular program, in this case, the Federal Housing Administration, will cover the mortgage balance to the bank. So it protects the bank, not the client. Lots of similar things between FHA and conventional, but FHA does have, its own features. Now let's review our features here. We have four easy ones to remember that will tell us if this is an FHA or not. First, we have the term. FHA and other government programs will start at 15-year term, go all the way up to 30 years, where, for example, conventional will start at 10. Second thing on the list, which FHA is known for, is mortgage insurance, or in short, MI. It's important to add that conventional also has it, but that's called private mortgage insurance, or PMI. They both serve the same purpose at the end of the day. Third feature we have is credit score. If you have a credit score lower than 620 and you still qualify for a mortgage, that's because FHA can go as low as 500 on credit score. And the last feature we have here is income. If income is pretty average, FHA would be a better fit since you can go up to 55% of your debt to income ratio to qualify. And with conventional, for example, you're capped at 50% of that debt to income ratio. So now that we've covered both a conventional and an FHA, it's time to go over a VA mortgage. Now, this particular part can be overlooked a lot, I think, in my opinion, but I just want to bring it up. Discharge status. Certain discharge statuses can affect the VA entitlement for a mortgage and therefore affect their qualification. Not necessarily a feature, but maybe a guideline. So let's go ahead and review some of those VA features. First, and the biggest in my opinion, is the loan to value. The VA allows you to put a mortgage that's worth the same value of your home. So for example, if the house is worth $100,000, you can put a mortgage against it for $100,000. Now, you can either include the VA funding fee in it or you can put it on top. Really depends on the structure. Another great feature is income. Government loans usually say 55% DTI as a cap, but the VA doesn't necessarily confine to that. You can go above 55% for approval in some cases, but it really varies on the strength of the file. And just add two additional features that I think are important to mention. One is there is no need for a down payment when you purchase a home. Unlike conventional and FHA, we have a down payment percentage you need to put. VA doesn't have that. The second thing is the VA will never have a mortgage insurance built into the payment when you refinance your mortgage. Even if you borrow against the house between 80% to 100% loan to value ratio, you're still not going to have mortgage insurance. And so something else that's worth mentioning is there is another element that clients will consider between all of these mortgage programs besides their qualifications, is the rate and the closing costs. You can have, for example, the same loan structure, but a different mortgage program, and can have a very different outcome for the rate and the closing costs. So, that, of course, is important. Now, there are other aspects of a loan structure you need to consider, but in general, I just wanted to say that these are some of the main ones people look at. And this is the end of our video. So remember, guys, each mortgage program has its own niche and features people like and don't like. Mortgages are very complex and not one sided. So it's important to remember that multiple factors apply when choosing the best financial solution for the mortgage. And lastly, I just want to say, guys, please don't forget to subscribe to the channel, like and share the videos, of course, but most importantly, leave a comment if you want to add anything I have left out on this particular topic, or comment with any other subjects you want me to explain in other videos. Again, thank you for watching, and I catch you on the next one.